afternoon, and thank you for joining KBRA's Dutch RMBS Methodology webinar. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, such as our recent RMBS report, which focuses on the Dutch housing market, can be accessed through the QR code on your screen or by visiting kbra.com. Here, you'll also find information on our upcoming events, including our annual European Structured Finance Symposium, which will take place in London this November. Should you have any questions on the topics discussed today, we are always available for a follow-up call, so please feel free to reach out to our business development team. Now, I'd like to hand things over to our moderator, Carl Cummins, for introductions.
Thank you, Michelle. Welcome, everyone. My name is Carl Cummins, and I'm a Senior Director in KBRA's Structured Finance team, where I work as a credit analyst, and I'll be moderating today's session. Today, we'll focus on KBRA's Dutch RMBS methodology, and in particular, the recently published country addendum for the Netherlands. We'll highlight how the addendum sits within our broader RMBS framework and the research that underpins the jurisdiction-specific assumptions. I would also like to point participants to the recent research report entitled Dutch Housing Market Update, Resilience Amid Regulatory Realignment, which is available on our website. I'm very pleased to be joined today by Callie Surgoudi, KBRA's Head of European RMBS, who will walk us through today's discussion. Welcome, Callie.
Good afternoon, everyone.
Callie, perhaps we can begin with some context. Could you explain the purpose of the Dutch addendum and how it fits within KBRA's broader European RMBS methodology?
Thanks, Carl. And grateful for the audience. Thanks, Carl, and grateful for the audience who have joined. Given the short duration of this webinar, I'll fly through some of the slides here. I feel each of these slides have a lot to unpack. And if I have intrigued you enough to speak to KBRA after this webinar, it would be a modest achievement. So KBRA has been active rating issuances in the European RMBS market since 2019. We have an overarching European RMBS methodology, which provides a general framework supplemented by jurisdiction-specific addendums to cover RMBS assumptions. We have addendums for the UK at the moment, Ireland, and Spain, and have now added the Netherlands to that list. The jurisdiction-specific addendums inform on the key attributes and factors to assess the risk of default and loss severity. In doing so, KBRA's RMBS addendums consider the nuances of mortgage products, and the history and liquidity of a mortgage market. Continuing on the framework covers various aspects related to loan credit analysis, RMBS modeling, KBRA European Mortgage Model, KEM, and cash flows analysis. As part of the ratings process, KBRA reviews the loan originator and the servicer, covering origination criteria, servicing capabilities, policies, and procedures, which determine the quality of originations and prospects of recovery in the event of default. KBRA expects to receive the agreed upon procedure report, usually on a 99-1 basis, to determine the data quality. The framework includes KBRA's general approach to the surveillance of RMBS transactions and reporting expectations. Lastly, the framework also covers KBRA's assessment of the securitization framework applicable to a jurisdiction and assessment of the structural and legal perspective of an RMBS transaction.
Great. With that foundation in place, let's look at the Dutch mortgage market backdrop that informs these assumptions. So, Callie, the Netherlands is one of the largest mortgage markets in Europe. Close to 40% of mortgage debt is NHG guaranteed, which is a distinctive feature of the market. Could you expand on the key characteristics of the Dutch RMBS market and any unique or differentiating features of the market?
Right. So the Dutch RMBS market has been prolific in its issuance volumes over the years and provides access to the capital markets for banks and non-bank lenders in the Netherlands. Dutch banks in particular actively use both RMBS and covered bonds as a diversified source of funding using residential mortgage assets. The total outstanding balance of Dutch mortgage, the total outstanding balance of Dutch RMBS issuance as at the end 2024 stood at 77.6 billion euros and stands second only to the UK RMBS market in terms of the RMBS outstanding. You're right, Carl, in stating that the Netherlands has one of the largest mortgage markets in Europe. The mortgage market exhibits a liquid residential property market as evidenced by the 206,000 property transactions in 2024, valued at 93 billion odd euros. 61% of the population has a mortgage loan, much higher than the EU average of 25%. The total mortgage outstanding is about 851 billion euros. You referred to the NHG, the National Hypothek Guarantee, is a distinguishing feature of the Dutch mortgages market. This guarantee is administered by WEV, which borrowers may choose to use. The NHG provides hardship protection in the event of job loss via temporary payment arrangements or coverage of mortgage debt that may remain outstanding after a forced sale. Further on the market, the mortgage market, one of the unique features is the diversity of financial institutions offering mortgages or holding them on their balance sheet, from traditional banks, non-bank lenders, to investment funds, insurers, and even pension funds. Banks, of course, dominate the residential mortgage sector. Historically, a strong labor market has in the past and continues to support Dutch mortgage performance, which has been key to build investor confidence in the asset class. Like other jurisdictions in Europe, Dutch mortgage lending volumes are swayed by the prevalent interest rate. The recent higher interest rate scenario saw mortgage lending demand plummet as affordability suffered, but that has now recovered. The second chart here highlights another key aspect of the Dutch mortgage market, which are these mortgages are offered at long-term fixed rates with reset at the end of such tenor. What's interesting is the borrower choice of different fixed rate tenors dependent upon interest rate cycles. Now, for example, what this chart shows you, and if I can pick up the period before, just before the interest rate rises in 2022, the proportion of loans with fixed rates longer than 10 years increased, which is depicted by the increase in the orange paint on that chart there, while the interest rates rose from 2022 to 2024, borrowers with an interest rate reset during these years, or first-time buyers, chose shorter-term fixed rates, and therefore the proportion of loans with fixed rates between 5 to 10 years increased, depicted by the increase in the green portion of the chart. Borrowers also showed a preference for floating rate interest during this rising interest rate scenario, exhibiting an ability to read interest rate cycles. And that brings me to the chart on the right, which depicts the performance of Dutch mortgages over the last decade. While correlated to the Dutch unemployment trends, like in any other European jurisdiction, shows a relatively better performance. Notwithstanding the high LTVs at which Dutch mortgages have traditionally been originated at, and being predominantly paying on an interest-only basis. Now, both these aspects, again, unique to this market. The performance is underpinned by strong affordability norms for origination using the NIBUD standards, long-term fixed interest rates, insulating against payment shocks, and low unemployment. And the last bit which I want to cover is firstly on the house prices, and next will be the buy-to-let sector. Now, the Dutch property market shows healthy liquidity. The demand for house purchase has at most times outstretched supply and is affected by interest rates and wage inflation determining affordability. The ebb and flow of the housing demand and supply as tempered by affordability has largely determined the growth or decline of house prices in the Netherlands, particularly since the COVID period. The Netherlands has a strong rental sector supported by demand for housing where renting can be cheaper than mortgage repayments in certain regions. Now, there is an indication of, if you look at the chart on the right, the price to rent ratio shows you that the rents have been rising, but so also have the house prices. So dependent upon the city or the region, the comparison between a monthly mortgage repayment amount to the rent is one of the key determinants of whether it is attractive for an individual and of course the deposit and the savings to determine whether the individual goes to borrow and purchase a property or rent. The buy-to-let sector currently, however, is witnessing an exodus of buy-to-let individual landlords, particularly in the big cities, Amsterdam, Rotterdam, Utrecht, and The Hague. Now, this is due to the Affordable Rent Act 2024, which introduced rent caps for middle-income properties, which affect rental properties in the big cities and less so for the smaller cities across the Netherlands. The buy-to-let sector has also been affected adversely by the higher property transfer tax and the purchase protection-related regulation. The growth in landlord-owned dwellings has fallen from 2% in 2024, which was around 6% in 2020. So clearly, the growth in the buy-to-let sector is tapering off because of as affected by this regulation. And overall, the Dutch mortgage market is thriving in a relatively stable environment, I would say, notwithstanding the recent interest rate cycle and the regulatory changes affecting owner-occupied mortgages on the LTV and the regulation around the interest-only mortgages and the buy-to-let sector.
Thanks, Kelly. I think that gives us a clear sense of the market environment. Now, let's move on to the foundation of the methodology, the benchmark loan and its probability of default. Kelly, KBRA determines a base probability of default, or KPD, for what it considers a benchmark loan. Could you walk us through what a Dutch benchmark loan looks like, and then what our probability of default assumption is around that Dutch benchmark loan?
Right. So a KPD, this is the KBRA probability of default. Now, this is dependent upon our assumptions around the benchmark loan base PD of 1.1%. I'll go into it in further detail in the next slide. This is also affected by a clutch of loan attributes and borrower attributes, and also dependent upon whether a loan is in arrears or not. There can be some subsectors or the market may have some of those assets outstanding which are non-conforming in nature or reperforming. Though I can definitely say that I do not expect the mortgage portfolios being securitized in the Netherlands to be in any of those last two sectors. Historically, there were two lenders who come to my mind, Elk and Qon, who had originated loans which would have fallen under the non-conforming category, but we don't see that any longer. So, so there can be some default probability overrides on account of those categories. But I think primarily we need to be focused on the loans which may be in arrears. And then you have pool level attribute. So we look at the geographic concentration of properties across different regions in Netherlands, which will then affect the probability of default at the pool level. If I then go into the next slide, which is on the benchmark loan PD. Now, in order to look at the benchmark loan PD and how it was derived at 1.1%, we considered the performance data available to us on all the publicly rated RMBS portfolios in Netherlands. And that historical data covered 2012 to 2024, and the vintages there spanned 1995 to 2024. Now, the benchmark loan is a loan with typical characteristics we find for loan originations in Netherlands. And these characteristics are listed so that it gives you a sense of what we've considered through our statistical regression analysis. And then it could be a loan. It is a loan, sorry, which is owner-occupied residential property with an OLTV of 95%, the debt to income of 4.5 times for the borrower as compared borrower's income as compared to the loan. It's a loan with fixed rate with future periodic reset. Borrower is a first-time buyer, full-time employed borrower with verified income, loan not in arrears, fully amortizing or interest-only loan with a linked principal repayment vehicle, first lien mortgage on the property. The property valuation is a full severe evaluation, and the loan is not NHG guaranteed. Now, what we're trying to establish here is these are the typical characteristics of a loan, which we found in the universe of all the loans which we were able to access and understand their performance. And looking at that performance based on these features, we established that the base default probability for a loan would be 1.1%. So these are statistical regression analysis which we use to arrive at this benchmark loan-based PD.
Okay, thanks, Kelly. So the Dutch benchmark loan carries a KBRA probability of default of 1.1% based on long-run securitized data. Now let's turn to how that benchmark is adjusted then for the different loan level attributes that you mentioned. Kelly, once we have the benchmark loan, how do we adjust then for loan level attributes? Could you highlight the most material drivers and then how these ultimately feed into the probability of default for a loan?
Right. So so every loan in the portfolio presented to us will be associated with a benchmark loan PD of 1.1%. Depending upon a specific set of loan attributes, let's consider OLTV and DTI. So OLTV at 95% is the feature of a benchmark loan, is neutral in terms of a PD adjustment. Now, if you present a loan which has an OLTV of 105%, and if you look at where this curve leads up to, it suggests that the PD should be increased by 10%. And on the flip side, if there is a loan presented with an OLTV of 85%, approximately it is a downward PD adjustment by 10%. So depending upon where the OLTV of the loan is along this curve, the PD is either higher or lower as per this particular chart in front of you. Second, the debt to income. Again, on similar basis, 4.5 times DTI is neutral in terms of an adjustment on the PD. That's part of the benchmark loan characteristic. Any loan with a DTI of higher than 4.5 times gets a higher PD adjustment. Loans with lower than 4.5 times DTI will have a PD adjustment lowering the base default probability. If I continue on the loan attributes again, you look at occupancy type. We look at buy-to-let, holiday, or second homes to be riskier. So we increase the default probability of such loans to such properties by 40%. NHG guarantee. So the benchmark loan considers the loan not to be NHG guaranteed. So if there is an NHG guarantee for a loan, we lower the default probability of such a loan by 25%. Interest rate type, fixed versus floating. Floating rate for life are considered riskier. We increase the default probability by 40%. And lastly, loan seasoning. So if you have, for example, if you have a loan which has seasoned for more than 36 months, we reduce the default probability by 10%. 48 months by 20%. 60 months or above, 30%. But this is conditional on the expectation that the loan is currently not in arrears. If the loan is in arrears and does fall into any of these categories, we do not provide that credit to seasoning in terms of lowering the default probability. Going on to the borrower attributes, here we have an adjustment for borrowers who are not first-time borrowers. For owner-occupied, not first-time borrowers, we lower the default probability by 25%. And if it is for a buy-to-let and not a first-time buyer, the default probability is lower by 10%. Employment status, self-employed and unemployed are considered riskier as compared to employed borrowers. Therefore, the default probability adjustments are higher. And then income verification is for non-buy-to-let only. You will see that for non-verified or fast-track or self-certified, there is an adjustment to increase the default probabilities. Of course, we do not see, we largely see verified income loans being originated in Netherlands for years now. And this was a legacy a feature of loans originated before, I think, 2008.
Okay, and you mentioned for loans in arrears, we apply overrides. Can you explain how these work?
Right. So the loans in arrears, what we're doing is, of course, for a benchmark loan, we consider such a loan not to be in arrears. If a loan were to be in arrears 1 to 2 months, a minimum 25% of KPD is assumed for the loan. Now, what this would mean is that if the loan and the borrower feature combined with that base PD result, you get to a KPD of 10%. You're considering only the loan, the borrower features, and the base PD. You get to a PD of 10%. The arrears status for this loan, if it were to be 1 to 2 months, would mean a minimum KPD of 25%. And that is what will be assumed for that loan with arrears in that category. Likewise, if the loan is 2 to 3 months in arrears, a minimum KPD of 50% is assumed.
Okay, and finally, KPD then is stressed further using rating multipliers at various different rating categories. Can you explain how those multipliers work and how they were calibrated?
Right. Okay, so what I would like to highlight on this slide is that once you've looked at the base PD, you looked at the loan features and the borrower features or those attributes, including whether the loan is in arrears or not, and arrive at the default probability of a loan, the KPD for a loan. We do this exercise for all the loans in the portfolio and aggregate that default number at the portfolio level. At the portfolio level default probability, that will definitely be adjusted for any property concentration in specific regions across Netherlands. And after that adjustment, we get to the default probability for the portfolio. And that is when I then worry about, because in RMBS transactions, I need to stress that default probability for the portfolio at different rating stress levels. What we then do is we look at multipliers. So in the single P stress scenario, I increase the default probability for the portfolio by 1.1 to 1.25 times. I allow myself that range because you can be presented with very slightly differing credit in different portfolios from different lenders. And likewise, in double B to AAA scenarios, you will have a certain range of those multiples. Those multiples increase so that we can then arrive at what is the stressed default probability for the portfolio in different rating stress scenarios. And these multipliers reflect the ratio of the KPD in a stressed environment to the KPD in a relatively benign environment. And they have been determined using observed defaults, which were the highest for the 2007 to 2008 origination vintages in the Netherlands.
Great. Okay. That sounds like default risk is covered. Let's move on to how we assess loss severity or recovery from default. Callie, can you take us through the main components then of loss severity, how we approach valuations, house price declines, stresses, and any additional adjustments we may consider?
Right. So for just in terms of the loss severity calculation, it is a math. So we look at the aggregate of the loan outstanding principal balance, the property liquidation costs and the carry costs, and the excess of this aggregate balance over the aggregate of the accumulated savings in the linked principal repayment vehicle, if it's an interest-only loan, plus property liquidation proceeds and any NHG guarantee proceeds if that loan is guaranteed by NHG. And that will give us the loss severity for a loan, KLS as we call it. The drivers for these KLS, so we start off with the valuation of the property. So we get a pool cut, we have the original valuation of that loan, of the property. We index the valuation of the property from the origination date to more recent date. And that we use, the indexation is using the house price data from CBS in the Netherlands. We may apply a haircut to the valuation if it is not a full surveyor valuation. If they are drive-bys or desktop or AVMs with possibly different confidence levels, and they are not considered as robust as full survey evaluations. So we will apply certain haircut to account for the valuation type. And then you have two haircuts there in order to determine the liquidation value. So one is the home price decline assumption, and second is the fire sale discount. Now, the home price decline assumptions vary between 5% in single B to 30% AAA. And what we have, how we've arrived at these numbers is to understand the movement of house prices in Netherlands through the cycle. For example, if you look at the peak to trough decline in house prices in Netherlands, post GFC, that was about 20% at the national level. And incidentally, if you look at our stresses there, that 20% number is a single A stress in our home price decline assumption. And second, of course, is the fire sale discount, which varies between 5 and 20%. Now, that is informed using the observed discount for repossessions. So we expect that debt lenders would be able to give us the information on repossessions where they have liquidated the property for recovery of the loan and determine what's the discount or how close is the liquidation value of the property or the sale price of the property as compared to most recent valuation of the property or an index valuation of the property. around the sale date. So that will determine what fire sale discount haircut we apply to the index valuation to determine the liquidation value of the property. Further, of course, as I said, the 40% of the loans outstanding have an energy guarantee. So it's important for us to consider the nuances of how the energy guarantee works, when claims are honored, and how those claims are honored based on energy rules. And then we consider the eligibility of a loan under the Dutch guarantee scheme. The loss amount is determined using the energy amortized balance, calculated assuming a maximum 30-year annuity schedule. Now, of course, there's a further detail to the calculation here, which is to consider recession rates. There are cases, and there's a certain track record where NHG finds a non-compliant loan or a claim from a lender on the loss which they have booked on a loan. For such a non-compliant loan, then NHG rejects the claim. So over the years, there's a certain rate of such rejections, and which then are determined by the recession rate. So what we've looked at that historical data, and what we've done is to apply the recession rates, which can vary between 5 and 40%. So 5% starting at the lower stress scenarios and increasing to 40% in the higher stress scenarios. And of course, we look to get such data from lenders and their experience, so that we can consider those observed recession rates in their claims with the energy.
Very good. And just into, I guess, the cost surrounding that, liquidation costs, foreclosure costs, and timing.
Absolutely, yeah, that's true. And then foreclosure cost assumptions are the aspects related to the variable and the fixed cost. Variable 4% of the liquidation value of property, and fixed costs on an average 6,000 euros. We also consider the liquidation timing. Now, this is to understand the carry costs, which varies between 16 months and 36 months, depending upon the rating stress scenario. And so I think that's the last bit, that's the last component which we consider for calculation of KLS for a loan.
Got it. Yeah. Okay, so we've gone through probability of default, loss severity upon default. The next step is how all of this flows into the modeling. Could you walk us through how these assumptions are then applied in the cash flow analysis? And presumably we deal with structural features as they're presented, such as revolving pools or further advances or different types of master trusts, etc.
Right. So on the cash flow side, of course, we look at firstly the asset cash flows as determined by the KPD assumptions, which we have at various stress levels, include as well as that for KLS. We look at the voluntary prepayment possible in Dutch RMBS transactions. So looking at the historical data, we use high prepayment scenarios and low prepayment scenarios. So high varying between 7 to 15%, and low prepayment scenarios varying 0 to 5%. And the next is when we determine the asset cash flows as impinged upon the simulation of default, we simulate those defaults using a front-ended default curve and a back-ended. Each of these default curves span a 10-year period. And so that will then also influence the cash flows from the assets. And then, of course, liquidation timing. This is applied in order to simulate the negative carry during the time that the lender or servicer is recovering on a defaulted loan. And we have interest rate stresses, which are considered. We have rising and declining interest rate scenarios. And of course, these are important considerations in terms of how the cash flows are influenced by where the interest rates are, as determined by these stresses, because predominantly you have assets and RMBS assets in Netherlands, which are paying you a fixed rate of interest. Small proportion may be floating. But then as compared to that, you are paying a variable rate of interest on the notes, the RMBS notes issued. Usually you will have a swap to hedge the risk of the fixed to floating. And I think in recent times, I do not see a total return swap being used in Dutch RMBS. It's normal fixed to floating, but there are nuances in the cash flow analysis particular to the Dutch RMBS. For example, the notional amortization mechanism schedule, the NAMS, and how it affects the cash flows, and where that NAMS related payment is subordinated in the waterfall. So those are specific nuances which need to be considered on a case-by-case basis when presented to us. But that's a summary of what we do for cash flow analysis. Of course, as you mentioned, Carl, if there are master trust or revolving portfolios or static portfolios with the potential for further advances and maybe loans with flexible features or flexible drawdown features, we will consider those as and when they are presented to us. So I think that summarizes my response on the cash flow side of the analysis.
Thanks, Kelly. That's very clear. That brings us to the Q&A portion of today's session. If anyone does have a question, please submit it through the Q&A chat box. I see two questions come in. I think, Kelly, the first is a more technical question on the KPT graph. I'm not sure if you can go back to that graph. I think it's the slide 14. Yes, so 14, one more, that's it. I think it's chart 2. So the question is, there's a cap visible in the KPD increase due to the LTI or loan to income. Can you explain why? I think my answer, well, I'll have a go first, and Kelly, you can please correct me. I think the question really is why is the LTV maxed out at kind of 15%? Whereas it goes down significantly on the left-hand side. So we are giving benefit as the debt to income kind of is lower, and ultimately we are penalizing it if it is above the 4.5. But in tail scenarios, I think the historical data showed that there was very little impact from a 6 times debt to income compared to kind of a kind of a more extreme range.
That's right.
That's the question, but Kelly,
So you see, we've considered the historical data of the loans originated in the Netherlands, and I was talking about the entire history and the vintages from 1995 onwards. In that, so that was the universe of transactions we looked at, and very clearly, you do not have, for example, low LTVs. Very few loans, I mean, whether they are data-related calculations which result in loans which are above 115%. So the population or the number of loans in that high LTV levels are very few. So it does not, make sense for us to actually have the curve going anywhere beyond that level of OLTV. Again, on the DTI side, it actually tapers off when it goes beyond that 5 times. It's only because you do not really see many loans which have been originated at a DTI above 5 odd level. So that's the reason why you will see that the PD adjustment just levels off on that. So it's just a function of what we see in the data and what the regression analysis on that basis showed us.
And I think it is reasonable to say that if there is atypical portfolios or if there's originators originating non-standard transactions or loans, I think we'll review that portfolio in isolation just to see if additional haircuts or overrides are necessary for that portfolio.
That's right. That's right. And we state that clearly in our methodology as well, that if something which gets presented outside the range of the data which we have looked at, based on which this methodology and these curves work, we will definitely consider adjustments.
Great. Two more questions. I think we still have time for them. First is a great question. Callie, with green mortgages now widely available in the Netherlands, how do you see sustainability features influencing RMBS analysis?
Okay, so ESG is definitely part of the conversation in Dutch market, particularly around the green mortgages. So the first aspect which comes to my mind is the borrower incentive. So you have the lenders offering slightly lower rates, which could support affordability and performance. So if you have a property which is eligible in terms of its energy efficiency ratings, we see that there are lenders who are able to offer certain incentives as far as interest rates are concerned. Second, of course, is the regulation. Minimum energy efficiency standards are moving closer to becoming law across Europe. Now, how these energy efficiency ratings influence the valuation? Now, does a more energy efficient property get better valuation estimations versus those which are worse in terms of energy efficiency ratings? Remains to be seen. If we see that data, we will definitely be able to consider that data in our analysis to see, do we provide credit here? Is there a consistent, meaningful difference between better energy efficiency rated properties versus those which are not? So yes, that's my response on that.
Thanks, Callie. And yeah, I think there have been a number of green transactions done in the Dutch market to date. Another question from the audience. How do you see the risk in increasing size of loans in the Dutch buy-to-let market?
Yeah, so the Dutch buy-to-let market is one which we are watching closely. Of course, there are a few pieces of regulation which have affected the market. And does it mean that the property is located in specific areas which are affected by, for example, the rent caps? Or does it mean that here is a property which is outside the scope of the rent caps? So if the loan size is what is what is being observed, but then in terms of the affordability of a mortgage to purchase that property means, in terms of rental cover, DSC, etc., means that there is there is a robust or there is good affordability in terms of repayment of the mortgage on a monthly basis. It may not be a concern, but second aspect is, does it mean that the higher loan amount means that the LTVs are conservative? So that can then also determine whether that can be a concern in the event of default, that you're not able to recover on the loan outstanding. So it depends on that DSC and LTV. So the loan size in itself, does it really mean there's a concern? Maybe not.
Okay, thanks, Callie. So that brings us to the end of today's session. Thank you, Callie, for walking us through the Dutch RMBS Addendum. And thanks to all of you for joining and for your questions. The full addendum is available on KBRA.com, as well as timely research. Please feel free to reach out if you do have any further questions on the methodology. On behalf of KBRA, thank you again, and we look forward to connecting with you at future sessions.